When most Canadian investors think about infrastructure stocks, they think about Enbridge. And Enbridge is extraordinary. 31 consecutive years of dividend increases, a 5% plus yield, approximately one-third of North American crude oil moving through its pipeline network. But here is the question most Enbridge investors have never asked. Brookfield Infrastructure Partners, a Canadian company listed on the TSX, manages ports, railways, toll roads, pipelines, electricity transmission networks, data centers, and cell towers across 6 continents. It has grown its distribution at an average of 6.8% annually for the past 10 years. 15 or more consecutive years of distribution increases. Actively expanding into AI data infrastructure. When did you last see it mentioned in a Canadian Dividend article? Almost never, because every article covers Enbridge, and TC Energy, and Fortis, and the same 5 names over and over. And the rest of the Canadian infrastructure landscape? A regulated Ontario electricity monopoly? A utility exporting Canadian propane to Asia? An independent power producer with 13 consecutive dividend increases that just signed a deal with Meta, and the best capitalized major pipeline company in Canada, sits in silence. This video is 5 of those names, each overlooked, each with a specific reason it belongs in the conversation that most Canadian dividend content never starts. Brookfield Infrastructure Partners owns essential infrastructure assets across 6 continents. Regulated utilities serving millions of customers in South America, Australia, and the UK. Transportation infrastructure including toll roads and rail lines, midstream pipelines and processing facilities, and a rapidly growing data infrastructure segment including data centers, cell towers, and fiber networks. The business model: own essential infrastructure that is impossible or impractical to duplicate, on long-term contracts with inflation escalators, generating stable cash flows through economic cycles. The data center angle: record Q1 2026 results with 10% FFO growth, led by data and midstream segments. BIP is actively growing its data infrastructure business, acquiring data centers and the physical infrastructure that AI computing requires. The company most investors think of as toll roads and pipelines is quietly becoming one of the most important owners of AI-enabling physical infrastructure globally. The distribution record: the dividend has increased by an average of 6.8% per year over the past 10 years, and has been stable with no material reductions to payments. BIP targets 5% to 9% annual distribution growth. Current yield approximately 4.6%. The BIPC option for Canadians, BIPC, was created specifically for investors who want standard corporate structure with eligible Canadian dividends rather than LP distributions, which matters for TFSA holders wanting the most favorable tax treatment. Same underlying exposure, different structural wrapper. The honest risk: BIP's payout ratio appears very high on a GAAP earnings basis. Infrastructure companies are properly evaluated on funds from operations, the cash generated after debt service. The FFO payout ratio is sustainable. But new investors must understand why GAAP earnings look the way they do before assuming the dividend is unsafe. Here is the vault: the Canadian infrastructure company that owns something you cannot build a competing version of, and whose earnings are essentially pre-approved by a government regulator. Hydro One owns and operates virtually all of Ontario's electricity transmission network, approximately 30,000 kilometers of transmission lines, and distributes electricity to approximately 1.5 million customers across rural and remote Ontario. There is no competing electricity grid in Ontario. You cannot build one. The capital required, the regulatory approvals needed, and the geographic rights already held by Hydro One make it a true natural monopoly. The regulated earnings model. The Ontario Energy Board regulates Hydro One's rates through multi-year decisions. Approximately 95% of Hydro One's revenue comes from regulated activities. The earnings are not subject to market competition. They are subject to regulatory approval. Hydro One files its cost of service application. The OEB approves the allowed revenue. Hydro One earns a return on its regulated asset base. The electrification tailwind. Hydro One is increasing its dividend to CA dollars 0.3331. Every electric vehicle plugged into an Ontario outlet increases electricity throughput on Hydro One's transmission and distribution network. Every heat pump replacing a gas furnace. Every new data center in Ontario. The electrification of everything is a structural multi-decade tailwind for the company that owns the wires. The numbers. Yield approximately 2.47%. August 2026. Annual dividend $1.41 Canadian. Payout ratio approximately 59%. Dividend growth target approximately 5% annually. Why nobody talks about it? Lower yield than Fortis and Emera. Ontario Utility sounds provincial rather than national. Went public only in 2015. AltaGas operates two fundamentally different but complementary businesses. First, a regulated natural gas utility in the U.S. Washington Gas serves Virginia, Maryland, and Washington, D.C. SEMCO serves Michigan. Traditional regulated gas distribution. Rates set by regulators, stable earnings, predictable growth. Second, Canadian midstream, specifically the Ridley Island Propane Export Terminal in Prince Rupert, British Columbia, which exports Canadian propane to customers in Japan, South Korea, and China. Why the Asia export angle matters. Asia is an enormous and growing consumer of propane for heating, cooking, petrochemical feedstocks, and increasingly as a cleaner fuel in developing markets. Canada's propane is competitively priced, and Ridley Island gives AltaGas a direct Pacific export route. AltaGas has quietly built a propane export franchise, generating cash flow from Asian customers, while most Canadian retail investors have never heard of it. The dividend record. This is our 6th consecutive annual dividend increase, which reflects the strength of our business model and demonstrates our commitment to consistently increase returns of capital to our shareholders. AltaGas is extending its 5 to 7% compounded annual growth rate guidance on dividends through 2030. The numbers. Annual dividend 1.34 Canadian dollars per share. Yield approximately 2.5% to 2.7%. 6 consecutive annual increases. 5% to 7% growth, CAGR guided through 2030. 2026 EBITDA guidance, approximately $2 billion, approximately 8% growth year over year. Why nobody talks about it? The U.S. utility plus Canadian midstream combination is hard to classify. The Asia export angle gets almost zero English-language retail coverage. The yield filters it out of income screens. Capital Power is one of North America's leading independent power producers. Approximately 12 gigawatts of generation capacity across 35 facilities, including natural gas, renewables, and battery energy storage across Canada and the United States. It is not a utility. It does not have regulated rates. It sells power into competitive markets, but increasingly through long-term contracted agreements that provide revenue visibility similar to regulated utilities. The data center power angle, in July, entered into a long-term energy supply agreement for 250 megawatts of capacity and energy with Meta Platforms, Inc., for a data center in Alberta. The AI infrastructure build-out requires enormous amounts of reliable baseload power. Capital Power, with its flexible fleet of natural gas and renewables, is positioning itself as the power producer of choice for data center developers in Alberta. This is not a speculative bet. It is a signed agreement with one of the world's largest companies. The dividend record increased annual common share dividend by 2%, representing the 13th consecutive year of increase. The dividend has increased by an average of 6.6% per year over the past 10 years and has been stable with no material reductions to payments. Management guides 8% to 10% annual AFFO per share growth through 2030, supporting ongoing dividend increases. Sub 50% payout ratio on AFFO basis. The numbers: annual dividend $2.76 Canadian per share. Yield approximately 3.85% to 4.3%, July/August 2026. 13 consecutive annual increases. 6.6% average annual dividend growth over 10 years. Investment-grade credit rating. Why nobody talks about it? Power generation sounds commodity exposed. It is less so than people assume with long-term contracts. Alberta Focus limits Eastern Canadian investor awareness. Smaller market cap than the utilities most content covers. The Meta deal is brand new. Coverage has not caught up. The honest risk: unlike a regulated utility, Capital Power's earnings are partially exposed to power price fluctuations in Alberta and other markets. The contracted revenue from deals like Meta provides visibility, but the uncontracted portion carries market exposure. This is not a bond-like utility. It is a well-managed power producer with real commodity exposure that sophisticated investors should understand before buying. Pembina Pipeline is one of North America's premier energy transportation and midstream companies. Pipelines, natural gas processing, fractionation assets, and export terminals across Western Canada. It is a major pipeline company. It just happens to be the one that almost never appears in Canadian dividend content, despite having the strongest balance sheet of the three major Canadian pipeline companies. The balance sheet advantage, PPL's debt over EBITDA, of 3.90 is best in class, well below TC Energy and meaningfully below Enbridge. In infrastructure investing, leverage is the primary risk amplifier. A lower debt load means more financial flexibility, more capacity to fund growth projects without diluting shareholders, and more resilience through commodity cycles or interest rate pressure. Pembina's balance sheet is genuinely superior to its peers, and this is almost never discussed. The growth pipeline: Pembina is advancing the Cedar LNG project, Canada's first major West Coast LNG export facility, a joint venture with the Haisla Nation. If completed, Cedar LNG gives Pembina exposure to Asian LNG demand through a Canadian-owned First Nations-partnered facility. The option value of this project is substantial and largely unpriced in current valuations according to several analysts. Pembina also guides 5 to 7% compound annual growth in fee-based adjusted EBITDA per share through 2030, driven by new projects across its pipeline and midstream network. The dividend record: monthly dividend of 74 cents Canadian per share. Yield approximately 4.47%. June 2026. 25-year dividend history, one of the longest in Canadian midstream. Fee-based business model. Pembina earns tolls on the volume of product flowing through its systems, not on the commodity price itself. Why nobody talks about it? Enbridge dominates the pipeline narrative. It is simply much larger and more famous. TC Energy gets the controversy coverage. Pembina sits quietly with a better balance sheet, a comparable yield, a 25-year dividend history, and an LNG growth option, getting almost no retail investor attention. 5 different companies across 5 different infrastructure segments. One connecting thread. All 5 benefit from structural protection that makes their cash flows more durable than most equity businesses. Long-term contracts, government-approved rates, geographic monopolies, or fee-based tolling arrangements. BIP earns long-term contracted, inflation-linked cash flows on infrastructure impossible to replicate. Hydro One earns OEB-approved returns on a transmission monopoly. AltaGas earns regulated utility returns plus midstream contracted revenue. Capital Power is increasingly signing long-term power agreements with tech giants that convert commodity exposure into contracted revenue. Pembina earns fee-based tolls on pipeline volumes regardless of commodity prices. None of these businesses compete on price in the way a retailer or manufacturer does. The structural protection, whether regulatory, contractual, or monopolistic, is the moat. And it is a moat more durable than brand loyalty or technology advantages. The coverage gap is simple. Financial media covers what generates search traffic. Search traffic follows fame. Fame follows coverage. The cycle is self-reinforcing. These 5 names are overlooked for coverage reasons, not for quality reasons. That is the distinction worth understanding before dismissing them. 5 Canadian infrastructure companies. 5 names that almost never appear alongside Enbridge and Fortis, despite operating with similar structural protection and, in many cases, comparable or superior dividend track records. Brookfield Infrastructure. Global essential infrastructure with 15-plus years of growing distributions and a new data center growth engine from the AI build-out. Hydro One, the Ontario electricity monopoly, with pre-approved earnings, no competition, and a structural tailwind from everything being electrified. AltaGas, regulated U.S. utility earnings layered with Canadian LPG exports to Asia, and 5 more years of structured dividend growth guidance. Capital Power, 13 consecutive dividend increases, 6.6% average annual growth over a decade, 8 to 10% AFFO growth guided to 2030, and a brand new contract with Meta that most investors learned about in this video. Pembina, the best capitalized major Canadian pipeline, a 25-year dividend history, lower leverage than both major peers, and a West Coast LNG option that is largely unpriced. These are not recommendations, they are introductions. Every one of them deserves a position on your research list the next time you are looking for Canadian income beyond the usual 5 names.